Struggling with the timing of your stock decisions? If the when to buy and sell dilemma has you scratching your head, then this video is your solution.
In the intricate world of stock market success, mastering the secrets to shortlisting stocks is akin to discovering the treasure map. Yet, the journey doesn't end there. It extends to another crucial chapter, knowing precisely when to part ways with your investments. Do you know that India has over 7,000 listed companies? With so many companies to choose from, how can an investor shortlist stocks for his own portfolio? If you use the regular method of studying these companies in detail, you will not have enough days in the year where you will be able to study all of them. You need some shortcut or some easy method whereby you can eliminate at least 90% of these companies. I'm going to tell you 2 easy shortcuts in this video, which will help you to do just that. First shortcut is that you need to look at the free cash flow of these companies vis-a-vis their net profits. Because most of the companies in India, they show high profits, but their cash flows do not substantiate this profit, which means that these profits are illusory. If you find that a company's free cash flow is less than 50% of its net profits over a period of 10 years, you can safely eliminate the company from your consideration. The second shortcut that you can use is to look at the return on equity of these companies. Let me explain you what return on equity implies. Return on equity is simply the return in percentage that you, the shareholder, as an owner of the company, will make on your capital. If a company is generating a return on equity of, say, 15%, that means that the company is able to earn 15% returns on the capital that is deployed on it. This return should not be confused with the returns you can expect to make on the stock by holding it. Or the company could be overvalued or undervalued. However, this return should be compared to the cost of capital of this company. Think about it. If a company is earning 8% return on its capital, but it is borrowing money at 10%, do you think this is a company which is worthy of your investments? No. So considering the high cost of capital in India, which for most companies could go into the 9 to 10% range, you need to select companies or shortlist companies which have a return on equity of at least 15%. This is the second way in which you can eliminate companies. By using both these methods, you can eliminate 90% of the companies in the universe of 7,000 stocks in India. Then study the balanced stocks more deeply before you buy them. In the stock market journey, uncovering secrets to shortlist stocks is like finding a treasure map. Yet the path continues. Now discover the vital skill of knowing when to sell stocks. Investors often wonder when they should sell their stocks, or when they should book their profits, or how long they would need to hold on to stocks. Well, as per the precepts of value investing, investors need to hold their stocks for at least 5 to 6 years. This is because it often takes the market time to value a stock at its true worth. If a value investor buys an underpriced security and he expects that the price would revert to fair value within a couple of years, he may be disappointed more often than not. As a result, he may not profit from buying underpriced securities. Now, this rule of 5 to 6 years has an exception. If you buy an underpriced security and it doubles in value in the next 2 years, and if the price which is prevailing then is deemed to be a fair price for the security, then an investor can make an exception and sell these stocks. As we conclude, you have mastered shortlisting and the art of timely exits. Empowered with this knowledge, navigate the market confidently, ensuring informed decisions and financial success. Well done.